If you remember last week on the Sofi Weekly podcast, we covered an article by IP Banking Research, which was in part trashing Sofi and also in part trashing the Sofi Weekly podcast, where it drew the inspiration for that article, arguing that SoFi should be valued by traditional bank metrics. Our main reactions and rebuttals to that initial article I'm attaching in a video linked up here, but this video is as a result of a new article that just dropped a few days ago by IP Banking Research titled SoFi or Discover, which digital bank to buy in 2023. Let's jump into it. Now, full disclosure, I read this article and generally didn't feel like making a video about it because I didn't agree with too many of the points. However, it caused a little bit of buzz through a Twitter thread, and quite frankly, I was asked by a viewer to share some thoughts on it. So first, let's recap the main argument in the article. In the previous article, IP Banking Research basically wanted us to compare SoFi to traditional players like Bank of America or JP Morgan. My main rebuttal to this argument, which again, it's in that highlights video on the Sofi Weekly podcast, was simple. Basically, SoFi's growth is more on par with a high growth tech stock than it is with a legacy bank, and SoFi also has a technology platform which is a long-term bull case as the AWS of fintech. And so that's why it's very difficult to compare it apples to apples with a Bank of America or a JP Morgan Chase. Fundamentally, these companies are at different stages of their life cycle, which makes a comparison very difficult to do and probably inaccurate if you do it either way, because you could argue both sides. In this newest article, IP Banking Research compares SoFi to Discover Financial Services, or DFS, a digital banking company. So this company is not quite like a traditional bank, but it's something a little bit more relevant from a product perspective, at least in terms of their offerings. After reading the full article by IP Banking Research, much of it is comparing the loan balances. It goes in depth on SoFi's loans held when entering a recessionary period. The main arguments are that SoFi does not reserve for expected lifetime losses, which is risky. Per his recent article, he views SoFi as unlikely to be able to sell their personal loans due to the falling demand in this tougher environment that we're entering in 2023. He does acknowledge that SoFi has plenty of capital to fuel growth. He mentions it's not clear whether the growth can be sustainable given this environment, but for the context of this video, we're going to zoom out a little bit, partially because I don't want to spoil the entire article, and the second reason is because I want to gear it more towards the everyday viewer without diving into the rabbit holes. I mostly want to share my thoughts on this article specifically and the points that I found interesting about it. For those who want to read the full article, you can do so in the description below. I've attached it. What I will say is, regardless of what the arguments were, it was definitely an interesting read from my perspective. Okay, so let's jump into a couple of thoughts. The first thought is that Discover Financial Services and SoFi have many similarities in terms of their products offered. However, DFS is much larger. Founded in 1985, they're the third most popular credit card company in the US. They're the fourth largest payments network by purchase volume, and they're doing way bigger revenue numbers. They're also profitable. All of this, to my earlier argument, makes it incredibly difficult to compare these companies because they are fundamentally at different areas of their life cycle. What often gets associated with that is argument number two. DFS is not growing nearly as fast as SoFi is. SoFi has had the bank charter for about a year now. Actually, today is their 1 year anniversary of getting that bank charter, whereas DFS has been around for much, much longer. SoFi has better growth rates than DFS, which is ultimately the reason that many investors are choosing to put their money in SoFi as opposed to DFS. IP Banking Research highlights that SoFi's total loan assets have grown by over 80% year over year, driven by personal loans, compared to DFS, which has grown by 17.2% year over year. Now, of course, DFS wins out on absolute numbers because they're handling way more money, they're way bigger, but the percentage numbers show that SoFi is growing at a faster pace comparatively speaking. IP Banking Research did highlight a disclaimer that the comparison was for which is the better investment in 2023, which would in essence negate this growth argument, because if I'm looking at a company's growth, I must be a long-term investor. I must be geared towards the next 5 years, the next 10 years, the next 20 years to hold this company until they see through their growth. But if I'm looking at what company I'm going to be buying in the next 12 months, then the growth would be less of a factor because that's something that compounds on a yearly basis. However, personally, I'm not going to be buying SoFi or DFS holding for 12 months, and then selling. The multi-year compounding growth is a huge motivator for me, seeing as my time horizon is long. And so this factor, I think, was not taken into comparison in the article, but if I'm looking at these two companies and thinking of it with my time horizon, the growth would be a huge contributing factor in that ultimate decision, which is not accounted for in the article because the time frame is so small. Number 3 is the arguments are almost exclusively made on traditional valuation metrics. The author bundles both companies as consumer lenders, focuses a lot on tangible price to book. Discover hovers around 2 to 3x, while SoFi's price to book has fallen from 6 down to 1.7, which of course in my eyes and in the eyes of many bulls has made it much more of a value play from a risk to reward perspective. However, on this point, the author argues that it's very challenging to assign a credible valuation to SoFi, which I think fundamentally we can agree with, especially in this whole comparison. It seems that many of the points against SoFi are simply unanswered questions around the loan balances, around some big macro downturn that could lead to trouble if this were to happen. I personally didn't find any of the arguments super compelling, but the thing that I did like about IP Banking Research's article is that he didn't outright bash SoFi or try to spread any FUD. It seemed like some of the numbers were cherry-picked, yes, but there was also a good amount of speculation. If this happens, then this other thing could happen. If we enter this period, then this could happen for SoFi. And that's how a lot of it went, with innuendos and inferences in terms of the risk associated with SoFi versus DFS, respectively. Ultimately, he ended the article acknowledging that there are many unanswered questions at the moment with SoFi, and he will need to wait for next few quarters for some of these answers to be revealed, which to me doesn't really scream of a compelling argument. It mostly screams as someone who is digging into a company and actually doing some due diligence. The other point that I found interesting, argument number 4, is that IP Banking Research was very bullish on the technology platform. In the conclusion of his article, he mentioned that the technology platform was a unique and attractive business model in the long term. He argued that SoFi should spin off their technology segment as a pure play on the AWS of finance, so that people who are more growth oriented can invest in that specifically, and people who are more traditional valuation oriented can invest in SoFi's bank or their lending business. And this was interesting because his previous article was saying that he didn't really have too much of an understanding of the technology platform. As a result of that, was valuing SoFi more towards a bank. And so that, to me at least, if I'm trying to draw some insights from this, points more towards this individual doing more research around SoFi's different business segments and naturally coming up with some questions. And while yes, lending is the biggest business segment for SoFi today, that's quickly changing, and we've talked about this numerous times on the SoFi Weekly podcast. One of the bullish arguments is that the 3 business pillars, lending, financial services, and the technology platform, will over time make a more even composition in the revenue mix. So while the dependency is heavy on lending today, it was much heavier 2 years ago, and it will be much less heavy 2 years from now because of the diversification of their product mix, the introduction of these new products, and that flywheel effect as a whole. However, this article doesn't take that into account, since it is a comparison for 2023 alone and not a comparison for the next decade, for example. I think that's a big gap that people need to bridge when trying to understand both sides of this argument, especially when comparing companies like DFS and SoFi. IP Banking Research concludes the article saying that he is on the sidelines when it comes to SoFi and prefers Lending Club, as Lending Club is profitable, even though the entire article was focusing on Discover and not on Lending Club. However, in one of the additional disclosures, he highlights that he may initiate a position in DFS in the next 72 hours. Overall, I think, just to recap this video, fundamentally every investor is different, and it's very difficult to compare large established companies with small, fast-growing ones. Aside from Will, who specifically asked for this video, a large part of why I wanted to make this was the debate that was happening on Twitter, where Chris Hager, who you'll remember had previously interviewed SoFi's Chief Financial Officer, Chris Lapointe, I think summarized it very well. And so I'll wrap up this video by reading a part of that thread. In his initial tweet, IP Banking Research asks, why should anyone buy SoFi when they can buy Discover at 6x? Chris Hager responds, because we aren't buying SoFi for its current financials, that'd be stupid. It's barely cash flow positive and has negative earnings. We're buying it for its trajectory, its vision, execution, and the ability to disrupt and grow. Discover is growing at a snail's pace compared to SoFi. To which Throwable replies, I found it's not worth having debates with value investors about growth stocks. It's not worth the effort as they have simply different risk profiles and preferences. And I think this summarizes the argument perfectly. You could cherry pick metrics all day long on either side of the argument, but fundamentally it's difficult to make it an even playing field. Personally, I'm investing in SoFi for the growth, for their cross-selling flywheel, for the diversification of product offerings, for their technology platform, and I have a long time horizon. All of these things were not mentioned in the article, and I think all of these are absolutely crucial in making a decision when comparing SoFi with Discover or Lending Club or Bank of America or JP Morgan or whoever else, right? And so you can cherry pick numbers, but that really won't help anyone to make an informed decision. I'd love to hear from you what you think. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.